I don't think the bond rally has begun in earnest yet. And I know that sounds crazy to say. Back in November, we were 3.25%. We hit a low of 193, so 40% of the yield got wiped out of the 10-year Treasury, but nothing has really happened yet. We're about to start the major central banks cutting rates. They're about to start expanding their balance sheets again. And when you look at money that's gone into money market funds, it's at a record high at $3.3 trillion. All that money could circle around and move into the bond market.
The Fed's going 25 or 50?
I think they're going to do 25. I don't really care whether they do 25 or 50, as long as there's sufficiently dovish language around that and they indicate it's not an insurance cut. They're serious about trying to create inflation expectations.
Huh. Do you think it's an insurance cut or not?
I don't think so. I think they're going out of their way to tell us that it's not. And the debate at the Fed is 25 or 50. If they do 25 and characterize it as an insurance cut, I'm going to sit all over the long end of the bond market, and I think money will pour in on top of it.
But you think it's a beginning of a rate-cutting cycle?
I do think so.
Rates are going to go that low.
I think the Fed is very concerned about inflation expectations becoming unanchored. If you listen to John Williams last week at the Central Bank Research Association, he talked about the risk that investors believe that the low inflation prints are not an aberration. They're a new normal. That's bad for central banks.
Okay, so you say, quote, we've had the recovery. It's coming to an end. Now the central banks, one after another, are falling into line and cutting rates. At this point in the cycle, you need some shock and awe. What does that mean? What's shock and awe?
I think if they do 50, they have to tell us that there will be more rate cuts coming. If they do 25, if I were them, let me put it in these terms. If I were them, I would do 25 at each of the next 5 meetings. Just take the Fed funds rate down to 1.25%, and send a message to the market that they're serious about raising inflation expectations. That's what they're focused on.
That would send a message.
Well, it should steepen the curve, and right now they don't have that.
So the growth of negative rates globally has been absolutely staggering. I'm sitting and listening to you and highly concerned that it's going to grow even more and potentially even come here, which I would never want to see. Do you believe that will occur?
I don't want to see that either. I don't like it. I miss the days when Treasury futures had an 8% implied yield on it. Those are so far gone. But the money that's pulled rates down to 2% has come from overseas. So what seems ridiculous to us, that the 10-year could go to 0, clients in Europe are telling me, you know what, that looks actually pretty high to me. That's where the money is coming from. Hopefully the Fed gets the message and the policy response is sufficient. It seems like they're getting the message. It seems like the ECB is getting the message, but they're going it alone. Where's the fiscal response? You're not getting that anywhere yet.
So negative rates can come here?
I would never have thought so. Everyone talks about the zero lower bound. I know John Williams' paper was titled The Zero Lower Bound. It's a fiction now. There is no zero lower bound. It's negative across Europe. In Europe, tomorrow, they're pricing a 10 basis point cut in the ECB rate. The ECB rate is minus 40 basis points. If you let inflation expectations become unanchored, then you have to go through these extraordinary measures. Hopefully, we don't get there.
Rob, you've touched on exactly what I think the real thing to watch next week will be, because I think universally, the majority of us are saying 25 basis points on the 31st. However, I think it's what is the signal as far as, is it a series of cuts that are coming our way? And if it's more walked back from that series of cuts, in other words, a cycle, if you will, if it's walked back from that, I think we could see a little sharp sell-off, at least in the short term. But as long as that door is still open to that series of cuts, I think it's going to be extremely positive. Even though we all agree it's not really the main driver for stocks, it would be people's perception that the Fed has their back and that they're going to see more people forced into this market.
There's a new Fed now. The Fed is us, right? they're former market practitioners, whether you look at Powell or Clarida. they get it. And the Fed could sit there and say, look, the economic data looks okay. Inflation's a little bit below our target. We can do 25 basis points. The market just won't accept that now. Instead, they've become the same discounting mechanism to the markets we've become. They're talking about global economic trends. They're talking about trade. They're talking about future inflation expectations. And they're trying to anticipate all of that now and pull policy forward to address that rather than wait till it materializes in front of us.